Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session where we are going to discuss a very important master action that the RBI has released, the directions that the RBI has released. So RBI has released the directions regarding the commercial banks, asset classification, provisioning and the income recognition. Okay, so in the previous session we have already discussed about the asset classification. In this session we will focus on the provisioning and the income recognition. So first of all, give me a thumbs up. I hope I'm clearly audible and the screen is visible. Okay. So today we are going to continue with the commercial bank asset classification, provisioning and the income recognition directions, which are very important from the examination perspective, as there are major changes that have been undertaken and the expected credit loss model has been adopted. So what will be the benefit of this expected credit loss model, as well as what is the provisioning and the income recognition norms? All of this we are going to discuss. So I hope I'm clearly audible. Okay, so let's get started. And the PDF of the session, you will get the PDF of the session in the Telegram channel of EduTap. Okay, so do not worry about the PDF of the session. You will get the PDF in the Telegram channel of EduTap. The link for the Telegram channel is provided in the description box below. Okay, so the link for the Telegram channel is provided in the description box below. Now let's start with today's article, that is the Reserve Bank of India Commercial Banks Asset Classification, Provisioning and Income Recognition Directions 2026. So these directions have been released by the Reserve Bank of India, and in the previous session we have already discussed about the asset classification, that which loans and what is the criteria for the non-performing asset, how a particular loan converts into the non-performing asset. So this we have clearly understood for the different kind of loans. I have also shown you that for the agricultural loans, the NPA is decided on the basis of the crop seasons, and for which agricultural loans, for that also there is the list that is provided, that for these particular agricultural loans the NPA is decided on the basis of the crop seasons. Okay. So all of this has been discussed in the previous session. Today we have to focus on the expected credit loss model. Today we have to focus on the expected credit loss model. So in the previous session we have started with it. I have given you the basic overview that under the incurred loss model, previously we were following the, or the banks were following the incurred loss model. But now the RBI has said that we have to move towards the expected credit loss model. So under the incurred loss model, what was happening, that the basic provisions, the provisions have to be maintained. The provisions have to be maintained for the standard assets. Okay, for the standard assets, the provisions were being maintained in between 0.25% to 1% normally. Okay, and when the loan has become NPA, when the loan has become NPA, that means for more than 90 days, there are no repayments that are happening, there are no principal payments or the amount that is being repaid. So the loan has become NPA. Now after the loan has become NPA, when the loan is coming under the standard substandard asset category, when the loan is coming under the substandard asset category, for the secured portion, 15% of the provisions had to be maintained, and for the unsecured portion 25% of the provisions had to be maintained. So you can understand that till the loan is becoming NPA for 90 days, it was recognized that the stress is coming because the principal payments are not happening, the interest payments are not happening. So in the initial period only, let's say that on 1st of June the EMI has to come. Now on 1st of June the EMI did not come, and for the 30 days, for the 30 days the EMI has not been paid by the borrower. So it has been recognized that the stress is coming, but still the bank is waiting for the loan to become NPA. When the loss has happened, after that the provisions are being maintained. When the NPA has been recognized and if the NPA, the asset will be called the substandard asset if the loan is NPA for a period of less than or equal to 12 months. That means after recognizing the NPA, after the NPA has happened, non-performing asset has become, then under the substandard category, under the substandard asset, the provisions will be maintained, the higher provisions will be maintained. And when the loan is going into the doubtful asset category, then even higher provisions are going to be maintained. So you can understand that incurred loss model focused on the loss, that once the loss is happening, once we have recognized the loss, then we will maintain the provisions. So the provisions were maintained for the standard asset, and the provisions are maintained, the provisions are increased after the standard asset has become NPA. But in the expected loss model, it is basically said that do not wait for the loan to become NPA. As soon as the stress is recognized that, okay, the EMI has not been paid in the past 30 days. So as soon as the stress is recognized, start maintaining higher provisions. Start maintaining higher provisions. So bank has to start maintaining higher provisions, okay? And the expected credit loss model also gives a formula for the banks so that the banks start maintaining higher provisions and the bank recognize the probability of default, that there is some probability of default even if NPA has not happened, but the loan is under stress because for the past 30 days, for the past 45 days, the EMIs have not been paid. NPA is only recognized when the EMI is not paid or when the payments are not coming for more than 90 days. Okay, when the payments are not coming for more than 90 days. But before those 90 days also, in 30 days only, the stress can be recognized. So since then, as soon as the stress is recognized, there has to be provisions that have to be maintained. Okay, so we don't have to wait. The banks don't have to wait for the loan to become NPA. As soon as the stress is recognized, let's say the EMI is not coming for the 30 days or for 45 days. So the loan has not become NPA because loan becomes NPA when more than 90 days have passed. Okay, so for 30 days the EMI has not been paid and such, so the stress has been recognized and higher provisions have to be maintained by the bank. So this is the expected loss model. Now expected credit loss based provisioning. So now we have discussed about the asset classification, that the NPAs are decided on the basis of what? Like when more than 90 days have passed, then NPA, the loan becomes NPA. When more than 90 days have passed, then the loan becomes NPA. Or in the agricultural loans, it depends upon the crop season. Okay. Then we discussed about substandard asset, doubtful asset, loss asset. Now coming to the expected credit loss based provisioning. That now the provisions will be maintained on the basis of the expected credit loss, not on the basis of incurred loss. Not on the basis of incurred loss. Okay. So before, the provisions were maintained on the basis of the incurred loss when the loss has happened, when the loan has become NPA. But now it has been said that now we will not wait for the loss to happen, the loan to become NPA. We will start maintaining the provisions on the basis of the expected loss that can happen in the future. So expected credit loss is a forward-looking estimate of how much money a bank might lose if the borrower actually defaults, if the loan becomes NPA. So it's a weighted average across different possible scenarios. That what if in the normal economic situation the loan becomes NPA? What if in the, like, if the war, the external circumstances become worse? What if in the worst economic situation, how much loans will become NPA, how much loss will happen in the future? So basically the probability is seen, that what is the probability of the default. Okay, so weighted average basically means the probability of the default is seen and the average amount is taken. Let me explain you with an example. So basically there are different circumstances, that in the normal economic situation, in the worse economic situation, and in the good economic situation, what will be the probability of default? Okay, in the good economic situation, for the micro, small, medium enterprises, for the corporates, in the good economic situation, when there is the boom that is coming in the economy, the probability of default will be less. ठीक है. While in the normal economic situation, the probability of default will still be minor. But in the worst economic situation, because of the external factors or because of the internal factors, if the economic situation has worsened, so the probability of default might increase. So average is taken. Okay, this is the weighted average, that what is the probability of default, and according to that the ECL is calculated, the expected credit loss is calculated on the basis of probability of default, that what is the probability of default, the expected credit loss is calculated, that there is higher probability of default or lower probability of default. On the basis of that, what is the expected loss, that is calculated, the average is calculated. Okay, so this is the idea, that expected credit loss is a forward looking estimate before the loss has happened, before the loan has become NPA. Before that only the provisions are increased and the expected loss is recognized. This is the idea. Now, financial instruments that are covered under the expected credit loss provisioning framework. So which instruments are covered under the ECL provisioning framework, that the provisions have to be maintained on the basis of the expected loss, not when the loss has been incurred. So now we are not going to follow the incurred loss model. When the loss has been incurred, when the loan has become NPA, only after that the provisions are increased. We are not going to follow this. From 1st April 2027, we are going to start with the expected credit loss model. Under the expected credit loss model, before the loan has become NPA, as soon as the stress is recognized, the provisions have to be increased before the loss has happened on the basis of the expected loss. On the basis of the expected loss, the provisions have to be increased. Okay, so that is the idea. Now, the financial instruments that are covered under the ECL provisioning framework, the loans that the bank is providing, the trade receivables, lease receivables, that is the bills that is purchased or discounted by the bank, debt securities that is purchased by the bank through the debt instruments, the bank is giving the loans or the investment to the corporates, other than those measured at fair value through profit or loss. Okay, loan commitments, including the undrawn loan limits, so the overdraft limits and such, or the credit undrawn loan limits. So loan limits have been provided. Okay, loan limits have been provided that might not have been drawn till now, but as soon as, like before the default, usually the limits are drawn. So if the borrower is going to default, it usually also takes the overdraft facility and all the facilities that the borrower can take before defaulting. So loan commitments, the overdraft facility, any other facility where there is an undrawn loan limit, like the partial credit enhancement and such that we have discussed in the previous session, that under these there are the limits that the borrower can draw, that the borrower can take. Okay, so these also come under the financial instrument covered under ECL provisioning framework. Of balance sheet credit exposures, that is the bank guarantee, the bank has given the guarantee, or the letter of credit that like the seller will be paid, the seller will be paid by the buyer if the buyer defaults, and the bank will be responsible for paying to the seller. Okay, so letter of credit is basically for the trade. So these are the off balance sheet credit exposures that in the future these kind of exposure can be for the bank. So these are the contingent liabilities, the future liability of the bank. The bank has given the guarantee or letter of credit. Any other financial asset that gives a contractual right to receive cash from the bank. So these are the instruments that will come under the ECL provisioning framework. That means basically all the loans or the promise of the loan or the bank guarantee that the bank has given. Which instruments will not be included or will be excluded from the ECL provisioning framework? So investment in the subsidiaries, associate or joint ventures, it does not come under the ECL provisioning framework. Okay, now calculation of expected credit loss based on risk level of credit. So risk level of credit, if there is no increase in credit risk, that means there is no SICR, no significant increase in credit risk. So if borrower's risk of default is almost similar to when the loan was first given, so bank is required to maintain provision, the basic provisions between 0.40%, 0.25% to 0.40% for losses that are expected in the next 12 months. That in if the borrower defaults in the next 12 months. Okay, if the borrower has become much riskier, there is significant increase in credit risk. In this case, bank is required to maintain provision for losses that can happen at any time. Okay, losses that can happen in the lifetime of the loan. So in the normal situations, when there is no increase in the credit risk, in this case, bank has to maintain the provisions for the loss that can happen or the default that can happen in the next 12 months. But in case there is significant increase in credit risk, in this case, bank has to maintain the provision for the losses that can happen at any time during the entire life of the loan. Next, calculation of fair valuation of loan on transition to ECL framework. So right now we have the carrying value of the loan. Carrying value of the loan is basically the value of the loan as per the historical accounting process, or as per the accounting process, what is the value of the loan, what is the value or exposure of the banks. Okay, while now it is said that now we need to calculate the fair value. Okay, clear? Now we need to calculate the fair value, that is the expected credit future cash flows. So expected future cash flows on the basis of the market condition. What is the fair value that the bank will receive? What is the value that the bank is expecting to receive in the future from the loan? So on April 1st, 2027, banks must calculate the fair value, that is the current realistic value of the loan, that how much the bank is actually expecting to receive from the loan, how much money will be retrieved from the loan. Okay, so carrying value is just the accounting value of the loan, that is the outstanding amount in such of the loan, while the fair value is the expected future cash flows, that is the actual money that is going to come to the bank. Okay, so this is the idea. Any difference between the fair value? So fair value is the value that the bank is expecting to actually receive in the future. Okay, while the carrying value is just the accounting value that the bank considers for the loan. So carrying value is just the accounting value, while the fair value is the actual amount that the bank is expecting to receive from the loan. This is the current realistic value that the bank is expecting to get back. So now it has been said that from 1st April 2027, the banks must calculate the fair value, that is the current realistic value of their entire loan portfolio. Any difference between the fair value and the existing carrying book or the book value must be adjusted against opening retained earnings. So let's say the fair value is higher or the fair value is lower. Okay, that means the bank is expecting to receive less. So to cover the amount, so bank, the carrying value of the loan is 100 crore, while the bank is expecting to receive 99 crore. That means there is the difference in between the fair value and the current value. There is the difference of 1 crore that will be covered through the retained earnings or through the undistributed profits that is kept by the bank, that is kept with the bank. That is the idea. Okay, so difference between the fair value and the carrying book value must be adjusted against the opening retained earnings. Next, how banks will record and track new or existing loans under the ECL framework. Which loans will come under the ECL framework? So new loans from 1st April 2027. So basically the ECL framework is applicable from 1st April 2027. From 1st April 2027, fair value and the fair value has to be calculated, and the loans, they have to be calculated on the basis of the fair value of their entire loan, the bank's entire loan portfolio, including all the outstanding advances. From 1st April 2027, banks must calculate the fair value for all the future loans and the outstanding advances also, the previous loans also. Now, new loans from 1st April 2027. Banks must record new loans at their current realistic value along with related transaction cost. Okay, so basically banks have to record new loans at their current realistic value, that is at the fair value, and they will come under the ECL framework. After initial recognition, the loan value will be calculated at the amortized cost. Amortized cost is basically the principal amount, that is the loan that was given, plus the EIR, that is the effective interest rate, minus the repayments minus the provisions. Okay, so basically what is the amount that the bank has to retrieve, how much the repayment has happened, and what are the provisions. So let's say principal amount is 10 lakh rupees, the interest is 1 lakh, the repayments are of 4 lakh, and the provisions are of 50,000. So the amortized cost will be calculated on this basis, that what is the exposure of the bank, like the principal amount that has been given, the effective interest rate minus the repayments and such. So this is the amortized cost. So loan value will be calculated at the amortized cost, principal plus the effective interest rate minus the repayments minus the provisions, using the effective interest rate. Now what is this effective interest rate? Effective interest rate is the actual overall rate that the borrower effectively pays. So effective interest rate, it includes the contractual interest rate, that is the 10% of the interest rate that the bank has to pay, as well as the bank is taking any fees, the bank is taking some transaction cost, some processing fees and such. So all these fees will also be included in the percentage form under the EIR. So let's say effective interest rate is 12.22%, including the processing fee, the yearly fee, or the transaction cost that the borrower has to pay on for the loan. Okay, so effective interest rate, it also includes the additional fee, the additional cost that the borrower has to pay. So effective interest rate is the actual overall rate that the borrower has to pay or the bank effectively earns on a loan, after considering not only the stated interest rate, the contractual interest rate, but also all related fees, charges, and the timing of repayments and such. So basically, till now the interest rate were calculated on the basis of the contractual interest rate, that this is the contracted interest rate of 10%. But now under the new effective credit loss model, the effective interest rate will be seen, that will also include the additional fees or the transaction cost that is paid by the borrower, that is earned by the bank. Okay, so effective interest rate will include all the payments or all the cost of the borrower. Now existing loans, so new loans from 1st April 2027, they must follow the fair value, they must follow the EIR, that is effective interest rate process. Now existing loans, all the outstanding loans as on March 31, 2027, as on March 31, 2027 shall be brought under the effective interest rate regime no later than March 31st, 2030. So remember that the existing loans that is till 31st of March 2027, they need to be brought under the EIR no later than March 31st, 2030. Okay? So loan commitments and off balance sheet exposures. So as soon as the contracts are being signed, the obligation will be treated as on date of initial recognition. Now, determination of significant increase in credit risk. This we have discussed, that the stage 1 is when there is no significant increase in credit loss. In this case, the provisions are to be maintained on the normal basis for the 12 months for the default that can happen in the future, in the coming 12 months. Okay, so for these instrumental loans which are in the stage 1, which have not experienced a significant increase in credit loss, bank recognizes the expected credit loss for the next 12 months. And in the stage 1, the provisions, the minimum provisions have to be maintained between 0.25% to 0.40%. Stage 2, the loan has not become NPA, the loan has not been credit impaired, but there is the significant increase in credit risk for the past 30 days, for the past 45 days, the interest has not been received, the EMIs have not been received. So bank recognizes the expected credit loss that result from possible default event over the expected life of a financial instrument. So when the loan enters the stress stage 2, that means the loan is under the stress, there is significant increase in credit risk. So in this case, the bank has to recognize the expected credit loss, the loss that can happen in the lifetime of the loan. In the entire duration of the loan, the default can happen. Okay. Stage 3, credit impaired, that means loan has become NPA. In this also, bank recognizes the expected credit loss for the entire lifetime of the loan, that means in the entire lifetime of the loan, the default can happen. At any time, the default can happen. According to that, the expected credit loss has to be calculated. The loss has to be calculated, and according to that, the higher provisions have to be maintained when the loan has actually become NPA. So in the stage 2 also, in the stage 3 also, the expected credit loss has to be calculated for the entire duration of the loan, that the loss can happen or the default can happen at any time, at any duration in the loan period. Okay, but in the stage 2, because the loan has not become NPA, so higher provisions have to be maintained, but only 5%. Okay, but in the stage 3, there are very high provisions that have to be maintained. Okay, so these are the prudential floors for ECL, that is the minimum provisions that have to be maintained against the expected credit loss that is expected. Okay, so what are the minimum provisions? So in the stage 1, when there are no defaults that are happening, or when there are no risk, no significant increase in risk, so minimum provisions of 0.25% to 0.40% for the standard assets, for the good assets. But in the stage 2, when it is recognized that there is significant increase in credit risk, because for the past 30 days, let's say, the payments have not come, so in this case, the expected credit loss is expected for the whole lifetime. That means in the lifetime of the loan, anytime the default can happen. Let's say the loan is given for the 5-year time period, so in the future 5-year, the loan can be defaulted at any point of time. Okay, so the provisions have to be increased because there is stress and there is significant increase in credit loss, so the higher provisions have to be maintained. Stage 3, when the loan has actually become NPA, then the provisions have to be further increased. Now this is for the secured portion, and this is for the unsecured portion. So for the unsecured portion, the provisions have to be increased from 40% to 100%. And for the secured portion, the provisions have to be increased slowly. Okay, these are the provisions for the different kind of loans that you can read once. Now, exposures guaranteed by central government. So if the exposures are guaranteed by the central government, that means there is the central government that is backing some exposures. So the prudential floor for the stage 1 is 0.25%, stage 2 also 0.25%. For the stage 3, when the loan has actually become NPA, at that time the provisions have to be increased. Here you can see that the provisions have to be increased from 25% to directly 100% for the unsecured or unguaranteed portion. Okay, but for the guaranteed or for the secured portion, the provisions have to be increased slowly. Now, additional information is that in respect of stage 1 and stage 2 exposures within each loan product category, the prudential flows, that is the minimum provisions that have to be maintained under the expected credit loss model, they shall be applied on a portfolio basis separately for each stage. Portfolio basis means that, let's say that automobile loans, for them the provisions 0.25%, 0.5% is for all the loans combined under a particular category, or for the consumer loans, retail loans, MSME loans. So on the category basis, on the product category basis, loan product category basis, the prudential floors can be maintained. So try to understand that, let's say in a particular loan, there is a higher default, higher probability of default, and there is the loss that is happening. But in the whole category, the average will be taken. And for the whole category, combining the whole category, the provisions will be maintained. So in the other loans, maybe the loss is not expected, the probability of default is low, so provisions will be maintained according to the whole loan category, loan product category. For the stage 1 and stage 2 exposures within each loan product category, the prudential floats for the provisions that will be maintained will be on the basis of the portfolio basis, on the basis of the whole category. But when it comes to stage 3, the prudential floors shall be mandatorily applied at the individual account level. For the stage 3 exposures, individual account level, the prudential floors or the provisions have to be maintained. The minimum provisions have to be maintained on the basis of the individual account level. So this is the idea. So basically for the stage 1 and stage 2, on the basis of loan product category, the prudential flows, the provisions can be maintained. The minimum provisions can be maintained where the bank decides to apply stage 1 and stage 2 floors at individual account level. So the bank can do so. But in the stage 3 exposures, the bank mandatorily has to apply the provisions, the minimum provisions at the individual account level. Okay, any confusion? So at the stage 1 and stage 2 exposures, the loan product category, on the basis of that, on the basis of the product category, the provisions have to be maintained. Minimum provisions have to be maintained. The bank can decide to maintain the provisions for the individual account level also, but for the stage 3, the provisions, the minimum provisions have to be maintained mandatorily at the individual account level. Okay, so that the individual risk is identified. Now, investment in a bond issued by a corporate shall attract the same prudential floor as applicable to corporate loans. So, whatever is the prudential floor for the corporate loans, that same prudential floor or that same provisions will be applied for the corporate debt securities also. Okay. For lease receivables and trade receivables for the bills discounted, loss allowances shall always be measured at an amount equal to lifetime ECL. That at any point of time in the loan, the default can happen. So that is the lifetime ECL. That is the lifetime expected credit loss, that the loss can happen at any time of the loan at any period, like in the first year, in the second year, in the third year, in the fourth year, in the fifth year, at any point of time the loss can happen. So that is lifetime ECL. That is the expected credit loss. The loss can happen at any point of time, the default can happen irrespective. So for lease receivables, trade receivables, it is not like the stage 1, stage 2, stage 3 doesn't matter, because it is expected that the loss can happen at any point of time. Okay, so for lease receivables and trade receivables, loss allowances or the provisions, basically the provisions shall always be measured at an amount equal to lifetime ECL irrespective of the stage of the instrument. Now, which instruments will always be kept in the stage 1, where it is considered that the provisions have to be maintained for the coming 12 months, the default can happen in the coming 12 months. Okay, so stage 1 are the normal standard loans where it is expected that okay, there is no lifetime risk or the provisions, the bank recognizes the expected credit loss for the next 12 months only. Okay, in the stage 1, for only the next 12 months the loss is recognized, the expected credit loss is recognized, that okay, the loss can happen in the coming 12 months and that will be a minor loss only. For stage 2, lifetime loss or the lifetime expected credit loss is calculated for the stage 3 also. Now, the bank may not be required to test the significant increase in credit risk for these kind of instruments, and they are always included in stage 1. So SLR eligible investments, direct claims on the central government, exposure fully guaranteed by the central government, exposure to the foreign governments, foreign central bank, multilateral development banks, bank for international settlement, which attract a risk weight of 0%. So they will always, these loans will always be included in the stage 1. Now, measurement of ECL. So see, what we discussed, the provisions that we have discussed for stage 1, stage 2, stage 3, these are the minimum provisions that the bank has to maintain for the expected credit loss. But how the expected credit loss is calculated? Okay? How the expected credit loss is calculated first of all. So expected credit loss is calculated on the basis of the probability of default. Let's say the probability of default is 20%. Multiply it with the loss given default, that what is the loss that can happen during default. So let's say loss that is expected during default is only 60%. Multiply it with the exposure at default, that how much is the loan that is left at default. So exposure at default, like the loan was given of 5 lakhs, but 3 lakhs have been received back. So 2 lakh is the exposure at default. 2 lakh is the exposure at default. So if you calculate it, 20% of probability multiplied by 60% of loss given default multiplied by the exposure. So 24,000 is actually the expected credit loss. This is the expected credit loss, and the loan is right now a standard asset. Okay, a standard asset. Let's say what was the prudential limit. Let's say the prudential loan, the prudential limit for the provision is that is prudential floor, not limit, but floor. Floor means minimum. Okay, prudential floor for the loan is, let's say, 0.40% of the exposure at default. So it is 2 lakh outstanding. So 0.40% of 2 lakh. So it is only 8,000. Okay. So see, expected credit loss, if it is higher, so the expected credit loss, whatever is the amount for that, that has to be maintained as provisions. But let's say that the probability of default has been kept by bank only 1% and the expected credit loss is very less, it is only 1,000. So whatever is the prudential floor, that is the minimum that has been decided, that has to be maintained. Okay. So expected credit loss is basically calculated on the basis of the probability of default, that for the in the next 12 month, what is the probability of default, loss given default means that the amount the bank may lose if the default happens 60%, 70%, that the bank may lose exposure at default. So probability of default cannot be less than 0.03%. So this is the minimum regulatory floor, that the probability of default cannot be less than 0.03%. Okay. Loss given default. So normally banks must estimate the loss given default using their own historical information and the other relevant data that the banks have. If they cannot estimate the loss given default properly, they must use RBI's backstop. RBI's loss given default values, that is for the secured portion 65%, unsecured portion 70% of the loss given default. These are the values that the banks have to use if the banks cannot use their own historical information to get to the loss given default. If the loan is backed by very safe assets such as the cash, that is the fixed deposits or the deposits, gold, securities issued by the central and state governments, LIC policies, Kisan Vikas Patra, national savings certificates, so the loss given default will only be 30%. Okay. The computation or estimation of the loss given default shall be subject to the internal validation of the independent team of the bank. So loss given default, the bank has to decide, but if the bank is not able to decide, then the banks have to use these loss given default. Now, if the ECL is higher, see, the prudential floor has been given by the prudential floor has been given. Prudential floor means these are the minimum provisions for the expected credit loss. So through the expected credit loss formula of probability of default, loss given default multiplied by the exposure of the bank. If through the expected credit loss formula, if the provisions are coming higher, then the higher provisions will be maintained. But if the provisions are coming lower, then these prudential floors have to be followed, because minimum this much provisions have to be maintained. Minimum these much provisions have to be maintained for the stage 1, stage 2 and stage 3. So that's why these are the stage wise expected credit loss estimates arrived at by the bank for loans falling under the below loan product category on the product wise, and these are the prudential floors, that is the minimum provisions that the bank has to maintain. So prudential floor refers to the minimum amount of provision that the banks must maintain under the expected credit loss framework. So according to their expected credit loss formula, they can decide the higher provisions, but these are the prudential floor, these are the minimum provisions that has to be maintained. So provisions cannot be lesser than these limits. Okay? So even if under the expected credit loss model, even under the expected credit loss formula, if the provisions are low, it doesn't matter, because the minimum provisions have to be maintained according to the tables that have been provided by the RBI. If the expected credit loss, according to that, the provisions have to be maintained higher, then yes, the higher provisions will be maintained. Now, use of effective interest rate. So basically, under the expected credit loss model, it has been said that the effective interest rate will be used. So ECL for a financial instrument originated or invested on or after April 1, 2027 shall be computed. So for loans, the financial instruments, the loans, the debt instruments that have been invested in on or after 1st April 2027 shall be computed using the EIR determined at initial recognition. For purchased or originated credit impaired assets, that means for the NPAs that have been bought at a very less rate by the bank. Let's say another NBFC has a or the bank has the NPA. So in this case, these are the originated NPAs. Sorry, the bank is originating this NPA, the bank has this NPA, or the bank has purchased the NPA, okay, at a very less price. So loans, the purchased or originated credit impaired assets, loans that are already risky at the time of purchase or origination. So banks must use a special credit adjusted effective interest rate, that how much money can be retrieved. So this is the idea, that the bank can purchase the NPAs of another bank, okay, at a very low rate. Let's say the loan amount is 10 crore, but at 1 crore the NPA has been purchased by another bank, because the another bank is expecting to retrieve more money in the future. So this is the idea, that for the purchased or originated credit impaired assets, there will be credit adjusted EIR that will be used for older loans. Now for the new loans that are going to be originated from the 1st of April 2027, the fair value has to be calculated, and whatever is the difference between the fair value and the carrying value, the difference has to be adjusted through the retained earnings. From 1st April 2027, whatever new loans that are originating, they must be following the effective interest rate criteria. Now what about the older loans? Okay, for the older loans, so for the fair value has to be calculated for the older loans also. Fair value has to be calculated for the older loans also, for the outstanding loans also, for the outstanding loans also, that is the older loans that are still outstanding, where the payments are still where the payments still have to be paid. Okay, so for the older loans that are outstanding, the fair value has to be calculated. But in the case of EIR, for the older loans that are given till 31st of March 2027, for that there is the timeline. For these older loans that are still outstanding, they will have to be shifted to the EIR by March 2030. That is the idea. Okay, so basically from 1st April 2027, the fair value has to be calculated for all the new loans, as well as for the outstanding loans the fair value has to be calculated, and the difference between the fair value and the carrying value has to be taken from the retained earnings. From 1st April 2027, the new loans, they must have the effective interest rate criteria under the ECL framework. But for the older loans, that are outstanding till March 31st, 2027, and if they are still present till 2030, so from 31st March 2030, they need to follow the EIR. So that is the idea. So for older loans that are outstanding as on March 31st, 2027, banks may temporarily use the contractual interest rate, normal contractual interest rate, that is usually used, let's say 10%, for opening the ECL calculation as on 1st April 2027. But all such loans that are still outstanding must fully be shifted to the EIR based system by March 31st, 2030. So basically the ECL, the expected credit loss calculation, will start from 1st of April 2027, and all the banks have to shift to the ECL framework. But in case of the EIR effective interest rate for the new loans, from 1st April 2027, but for the older loans that are still outstanding from till March 31st, 2027, for them the EIR effective interest rate criteria has to be followed from 31st March 2030. Okay, so this is the idea. Now, role of collateral in ECL calculation. So when banks calculate expected credit loss, they do not assume that the entire loan amount will automatically be lost. Basically, there is the collateral also, right? There is the collateral also. So in the situation, if a stage 3 high risk loan exposure is more than 7.5 crore, in this case, bank must get the collateral valued through valuers appointed as per its internal policy at the time of stage 3 classification, and thereafter at least once every 2 years. So this is the idea, that if a stage 3 loan exposure is more than 7.5 crores, then as soon as the loan has reached to the NPA category, to the stage 3 category, so the valuation of the collateral should happen, and after that once every 2 years the valuation of collateral should happen. In the case if a loan has become if the loan has become the stage 3, that is very high risk, and there is the stock or inventory that is kept as collateral, the machine, tools, equipments, the stock, the inventory is kept as collateral, bank must revalue the stock or inventory collateral at least once every year. Oversight Committee for ECL Framework, a committee of the board or a board approved committee, including the Chief Financial Officer and the Chief Risk Officer, shall oversee the robust implementation of the ECL framework. From when? From 1st April 2027. Okay. Additional provisioning rules. So if a company has directors that are other than nominee directors of the government or financial institutions brought on board at the time of distress, so if a company has directors that are listed as willful defaulters, banks must keep an additional. So let's say the bank has given loan to the company and the company has directors that are willful defaulters, so if the bank has given loan to a company and some directors of the company are willful defaulter, or if a company has directors that are listed as willful defaulters, banks must keep an additional 5% of provision over and above the provisions determined under the ECL and the minimum provisions if bank has exposure to such company. Okay. Measures to mitigate the impact of transition to the ECL framework. So from 1st of April 2027, the bank has to shift from the old provisioning system to the new expected credit loss system. So there was the old provisioning system of the income recognition, asset classification, and the provisioning norms. So these were the old provisioning norms. These were the old asset classification and income recognition norms. So now the banks have to shift from the old provisioning norms to the new expected credit loss framework from 1st April 2027. Now the bank will compare the ECL, the expected credit loss that is required on 1st April 2027, that is the provisions that is required according to the expected credit loss model as on 1st April 2027 with provisions that are already held under the old norms on 31st March 2027. So under the old income recognition, asset classification, provisioning norms, there are some provisions that are maintained till 31st March 2027. Okay. Now under the expected credit loss, the provisions will be calculated and the provisions have to be maintained from 1st April 2027 for all the new loans, for all the previous loans also. Okay, for all the new loans, for the outstanding previous loans also. Now let's say that there is a difference. The provisions under the ECL says that there should be the provisions of 50 crores, while under the old provisions there are only 45 crore of provisions that were maintained. So these provisions are less. Old provisions that are maintained as per the old criterias, they are only 45 crores, while as per the ECL, the new provisions as per the ECL expected credit loss model, the provisions for the new outstanding loans should be 50 crore. So this 5 crore of the difference will be paid through the retained earnings, and these 5 crore should not be shown in the profit and loss account as a loss. This 5 crore or whatever is the difference between the old provisions and the ECL provisions, whatever is the difference, has to be covered through the retained earnings. Now, as you know that in the CRAR that we have discussed in the previous session, there is the tier 1 capital that consists of common equity tier 1 capital. Now, in the common equity tier 1 capital, the retained earnings are added. Under the common equity tier 1 capital. So these retained earnings are the earnings that the bank is keeping, the undistributed profit that the bank is keeping. Now, if the 5 crore or whatever this amount is, let's say, as per old provisions for the loans till 31st March 2027, the provisions that had to be maintained were 500 crores, while as per the ECL framework, the provisions that have to be maintained is 600 crores. So there is the difference of 100 crores that has to be covered through retained earnings. Okay. So this 100 crores of the difference for the new framework, for the ECL provisioning framework, the 100 crore of the difference has to be covered through the retained earnings. So if the money will flow from the retained earnings to provisions, so retained earnings will reduce. That means common equity tier 1 capital will reduce. That means the CRAR that the banks are maintaining might reduce. The capital against the risk weighted asset might reduce. So basically it has been said that the transitional adjustment amount, whatever is the adjustment amount for transitioning from the old provision norms to the ECL provisioning framework, whatever is the transitional adjustment amount should be adjusted against the opening earnings, that is the retained earnings of the bank on 1st April 2027. It should not pass. So the transitional adjustment amount, this adjustment amount, it should not pass through the profit and loss account. It should not be shown as loss, because then it will reduce the profits of the bank. That will affect the shareholders also. So it should not be passing through the profit and loss account. It should only be adjusted against the retained earnings of the bank. This reduces. Now, if the retained earnings are reducing because of the higher provisions under the ECL provisioning, because of the higher provisions, the retained earnings are reducing. This will reduce the common equity tier 1 capital of the bank. This will affect the CRAR requirement of the bank, and many of the banks might fail to meet the minimum criteria of 9% of the CRAR. So to reduce the sudden capital stress, the RBI allows the bank to temporarily add back part of its adjustment amount into CET capital up to 31st March 2031. So basically, maximum fraction of transitional adjustment amount that may be added back to CET1 capital. So basically, the transitional adjustment, let's say 100 crores is the transitional adjustment. So 4/5 of the amount can be still shown in the common equity tier 1 capital. Okay. So basically, I think 80 crore can be still shown in the common equity tier 1 capital. Only 20 crore will be deducted from it. In the next year, 3/5, next year 2/5, then 1/5. Okay. So this is the idea that common equity tier 1 capital will, the amount will be taken at one go, but the transitional adjustment amount that may be added back, but it will be added back. So from the common equity tier 1 capital, the provisions will be taken, the additional provisions that are required will be taken, but it will be slowly shown in the common equity tier 1 as the deduction. So in the first year, 4/5 will be added back to the CET1. That means only 1/5 will be deducted. In the next year, 2/5 will be deducted. In the third year, 3/5 will be deducted. And in the fourth year, the rest of the amount will be 4/5 will be deducted. Okay. So this is the idea. Any confusion here, anyone? Any confusion? So basically, whatever is the transitional adjustment amount from transitioning from the older norms to the new norms to the ECL provisioning requirement. So whatever is the transitional adjustment amount that has to be adjusted against the retained earnings. So if the transitional adjustment amount is 100 crores, so that has to be reduced from the retained earnings, but that will reduce the common equity tier 1 capital. So that rather than reducing the common equity tier 1 capital at one go, there is a timeline that is provided that in the first year, only 1/5 will be deducted and 4/5 will be kept in the common equity tier 1 capital only. In the second year, 2/5 will be deducted and the 3/5 will be kept in the common equity tier 1 capital. Only 3/5 will be deducted in the third year and 2/5 will be kept in the common equity tier 1 capital. So if the provision, so this is the basic idea. Okay. Now, coming to the next one, income recognition. So we have discussed about provisioning now. I hope this is very much clear. Let me just summarize everything. So the provisioning, asset classification has been done in the previous session. Provisioning norms, we have discussed everything in this session. So in the provisioning norms, basically from 1st April 2027, the provisions have to be maintained on the basis of expected credit loss model. Okay. On 1st April 2027, the fair value has to be calculated for all the new loans and for the outstanding loans also. Whatever is the difference between the fair value and the carrying value or the book value, so that has to be reduced. So whatever is the difference between the fair value and the carrying value, so that has to be covered through the retained earnings. From 1st April 2027, for the new loans, the effective interest rate should be used, that is including all the additional fee charges of the banks also. Okay. Other than the contractual interest rate, it also includes the fees, transactional cost and such. For the old loans that are given till 31st of March 2027, for the old loans to accept the EIR facility or to accept the effective interest rate, the timeline is given till 31st of March 2030. But these loans also, that are the outstanding loans that will accept the EIR by 31st March 2030, they have to start maintaining provisions on the basis of ECL. Okay, so ECL, that is effective credit loss provisioning, this is going to start for all the loans, new loans, older loans, outstanding loans. That is the ECL, the effective credit loss based provisioning has to be maintained from 1st April 2027 for all the new loans, for all the outstanding loans. Okay, this is the idea. Now for the ECL, the formula is given, that is probability of default, loss given default multiplied by the exposure at default. So this is the formula for ECL, and according to this the provisions will be maintained, but the provision should not be lesser than the prudential floor that is provided. So if according to ECL the provisions are higher, that is good, but the ECL provisions should not be less than the prudential floor that is given by the RBI. So ECL, the probability at default, loss given default, this is decided by the bank. So the RBI is saying that as per the internal policy, you can decide your ECL, expected credit loss, and the provisions that the bank should maintain. Okay, but it should not be less than the prudential floor that is decided by the RBI. So RBI has decided the minimum provisions that we have seen in the table format. Okay. Now coming to the income recognition. For loans and investment exposures, originated on or after 1st April 2027. That means the new loans. The bank shall recognize the interest income using the effective interest rate method as long as the asset remains in stage 1 or stage 2. Okay. So basically effective interest rate has to be started using for the new loans from 1st April 2027. For loans outstanding as on 31st March 2027, banks may temporarily continue to use the contractual interest rate or the normal interest rate using the contractual interest rate. However, from 1st April 2030 onwards, all loans, either they are new or they are older, that is they are outstanding, must mandatorily use the EIR method. So basically the same thing has been said here also, that the ECL has to be followed, the ECL based provisioning has to be followed from 1st April 2027. The EIR, effective interest rate, has to be followed for all the new loans from 1st April 2027, but for the old outstanding loans, that are outstanding till 31st of March 2027, for them the EIR has to be adopted by 31st of March 2030. The EIR has to be adopted by 31st March 2030, so that from 1st April 2030 all the loans, previously outstanding loans and the new loans, they have the effective interest rate. Okay? So from 1st April 2030 onwards, all the loans should have EIR. In respect of the below financial assets, interest income shall be not be accrued and shall be recognized only on cash basis. That means for the purchased or originated credit impaired assets, or the assets that later become credit impaired, that become NPA, for them the payments will only be recognized, the receipts will only be recognized when the money has been received. Okay. Reporting timeline, this is the last, then we are going to end the session. Okay. Banks will shift to the ECL framework from 1st April 2027. The first financial reporting under the ECL will be based on the financial position as on 30 June 2027. So banks will shift to the ECL framework from 1st April 2027. The first financial reporting under the ECL will be based on the financial position as on 30 June 2027. Banks shall parallelly continue to report quarterly unaudited financial results under existing regulations and in line with up to 31st December 2027. Okay. So bank can parallelly do the reporting. The first reporting as per the ECL framework, wherein banks are required to present the previous year comparatives, shall be done starting from March 31st, 2028. So this is it. Now, this is the first question. I hope you will be easily able to answer the question, that as per the recently released Commercial Banks Asset Classification Provisioning Income Recognition Directions 2026, which of the given statements below is or are correct? So a reputable presumption of SICR arises when payments are overdue for more than 30 days. So this we have discussed in the previous session under the stage 2 when we were discussing. Try to answer this. Prudential flows for stage 3 exposures are mandatorily applied at the individual account level. Investments in subsidiaries and joint ventures are included in the ECL provisioning framework. So try to answer this, okay? Next is consider the following statements and which of the above statements is or are correct. Banks should normally estimate LGD, loss given default, using internal historical data. Regulatory LGD for unsecured portion is 70% if the bank cannot estimate internally. Regulatory LGD for banks backed by gold collateral is 30%. So try to answer this question. Last question is consider the following statements regarding commercial banks, asset classification, provisioning and income recognition for loans and investment exposures originated on or after 1st April 2027. Banks should recognize the interest income on the basis of EIR. Stage 3 exposure above 5 crore require collateral valuation at least once every 2 years. The minimum regulatory floor for 12-month probability of default is 0.03%. So do tell me that which of the above statements is or are correct. So this is it for today, and do go through the directions again, read through them so that you have the clarity. Okay, I have explained the important things, but go through the whole PDF so that you have the clarity. So this is it for today. Do give the right answer of the homework question, and you will get the PDF of the session in the Telegram channel of EduTap, for which the link is provided in